Something is happening right now that the biggest banks in the world are telling their wealthiest clients about in private research notes, and almost none of it is reaching the people who need it most. We are standing on the precipice of a financial paradigm shift so profound and irreversible that the elite institutions managing trillions of dollars are quietly restructuring their entire worldviews, while the average person is left entirely in the dark, distracted by the daily noise of the mainstream news cycle. There is a silent, creeping reality taking hold across the global economy right under our noses. And it is a reality defined by the unambiguous truth that your hard-earned money is being devalued overnight. When most everyday people hear the word devaluation, they mistakenly imagine a dramatic televised broadcast where a distressed government official steps up to a podium in a panic and officially announces that the national currency is suddenly worth significantly less. But that is absolutely not how modern devaluation happens in our highly financialized era. Devaluation happens silently, relentlessly, and without any formal announcement. It is a slow, methodical extraction of your purchasing power, engineered by a global central banking system that has completely run out of mathematical options. The biggest reset is now, and it is not some distant theoretical future event for economists to debate in academic journals. It is an active, accelerating process that you are living through at this very moment, whether you realize it or not. If you truly want to understand what is happening beneath the surface of the global economy, you have to completely stop listening to the public relations statements meant to pacify retail investors and start decoding the private research notes circulating among the financial elite at institutions like Goldman Sachs, UBS, and JP Morgan. These massive banks are not operating on blind hope or political loyalty. They are operating on cold, hard macroeconomic data. And the data paints a terrifying picture of a landscape where catastrophic sovereign debt levels are forcing central banks into a desperate, inescapable corner. We are facing a global debt crisis of such magnitude that the only viable way out for governments is to monetize the debt. Let me translate that complex financial jargon into plain English so you can see exactly how this impacts your family. When a government or a central bank says it needs to monetize debt, it simply means they are going to print massive quantities of new money out of thin air to pay for unfunded obligations they cannot possibly afford through normal tax revenue, because genuine fiscal consolidation, which means actually cutting government spending and balancing the national budget, is politically unacceptable and mathematically impossible at this late stage of the debt cycle. This creates a vicious, inescapable cycle. As they print more money to cover their massive shortfalls, the total supply of fiat currencies rapidly expands in the system, which silently and permanently shrinks the purchasing power of every single dollar, euro, or yen you currently hold in your savings account. This is the hidden, insidious tax of inflation, and it is the exact mechanism through which the working and middle classes get hurt the most, while the asset-holding class gets vastly richer. The urgency of this situation absolutely cannot be overstated. We are moving rapidly and dangerously toward a prolonged environment of severe stagflation, where underlying economic growth stagnates, businesses struggle, and job opportunities dry up. But consumer inflation continues to compound aggressively, completely destroying the real yield on traditional conservative investments like government bonds or basic savings accounts. The financial elite understand this terrifying dislocation perfectly. They know that the current fiat system is incredibly fragile, and they are taking swift, decisive action behind closed doors to protect their wealth from the coming storm. Recently, we saw a private research note from Goldman Sachs that was incredibly revealing to anyone who knows how to read between the lines. Despite a massive headline-grabbing pullback in certain asset classes, Goldman Sachs maintained a highly bullish, unwavering stance on gold and precious metals. In the secretive world of high finance, when a major bank like Goldman Sachs tells its ultra-wealthy clients that they remain constructive on a particular asset, that is their polite, institutional way of saying, We are buying this aggressively right now, and you should be allocating your capital here immediately. They are looking entirely past the short-term daily volatility that shakes out weak retail hands, and they are focusing intensely on the long-term convergence of undeniable macroeconomic forces that guarantee higher prices for hard assets. But this brings us to a critical point of immense confusion for many everyday retail investors who are trying to make sense of the markets. If the underlying fundamentals for gold, silver, and other hard assets are supposedly so strong, why did we recently see a sudden, terrifying 12% drop in the market that wiped out so many small traders? This exact scenario is where retail investors succumb to fear and panic, while institutional investors step in and profit massively. To truly understand this 12% drop, you have to understand the critical difference between a fundamental shift in an asset's true value and a temporary liquidity event. What we witnessed during that sharp downturn was not a rejection of gold's intrinsic value by the smart money. It was a pure, unadulterated liquidity event driven by severe mark-to-market losses and aggressive margin calls spreading like wildfire in the broader financial markets. Let me give you a very relatable analogy to make this complex market dynamic crystal clear. Imagine a jobless homeowner who suddenly realizes he cannot pay his mounting bills. He has a garage full of incredibly valuable high-end tools, a pristine vintage sports car, and a beautiful, fully paid-off house. When the aggressive debt collectors come knocking on his door demanding immediate payment, he does not sell his prized possessions at a steep discount because he suddenly thinks they are worthless. He sells them because he is deeply distressed and desperately needs liquid cash right now to survive. He sells his absolute best, most valuable assets first because those are the only things that have immediate, ready buyers in a tight market. In the complex financial markets, the exact same dynamic plays out on a massive scale. When massive hedge funds and highly leveraged institutional traders take catastrophic losses on bad equity bets, commercial real estate plays, or risky derivative trades, they face immediate margin calls from their prime brokers. Their brokers demand cash immediately to cover the massive holes in their accounts. To raise that massive amount of cash overnight, these distressed, over-leveraged funds are forced to liquidate their most liquid, profitable, and easily sellable assets. They frantically sell paper gold contracts on the COMEX futures market. They dump massive amounts of these paper contracts into the market all at once, overwhelming the buyers and driving the spot price down artificially in a matter of hours. This is entirely a paper market illusion, not a physical market reality. The fundamental intrinsic value of the underlying physical asset has not changed one bit. Only the immediate desperate cash needs of wildly leveraged speculators have changed. The 12% drop was a desperate scramble for liquidity, a forced selling event by those who were caught over-leveraged, not a fundamental signal that the core thesis for holding hard assets to protect against currency debasement is broken. While the average retail investor looks at their screen, sees a 12% drop in price, and panic sells their holdings at a massive loss, the elite institutions see a deeply discounted generational buying opportunity and aggressively allocate more capital to acquire those exact same assets. They know beyond a shadow of a doubt that this temporary paper market manipulation only masks the underlying undeniable truth of massive physical accumulation happening behind the scenes. And nowhere on the planet is this relentless physical accumulation more evident than in the strategic, highly calculated actions of Eastern central banks, particularly the People's Bank of China. Now let me turn to the profound, earth-shattering shift currently happening in the East that the Western media largely ignores. For several decades, the entire global financial system was built on the unquestioned dominance and perceived safety of the US dollar. But over the last few years, we have seen the aggressive weaponization of the dollar in global geopolitics, the heavy-handed use of economic sanctions, the unprecedented freezing of sovereign foreign exchange reserves, and the restricting of access to vital international payment systems have sent a massive shockwave of fear and realization through the central banks of the entire world. Powerful countries like China, Russia, and various rapidly growing emerging markets across the BRICS nations have suddenly realized that holding their national savings and sovereign wealth in fiat currencies controlled entirely by Western political powers is an absolutely unacceptable strategic vulnerability that threatens their national sovereignty. Consequently, there is an accelerating, undeniable trend of Eastern central banks quietly but aggressively buying massive quantities of physical gold. They are literally draining the Western vaults, systematically exchanging depreciating paper promises for tangible, historically proven wealth. This is not a short-term speculative trade for these powerful nations. It is a critical matter of long-term national security and fundamental economic survival in a shifting multipolar world. When you see the People's Bank of China officially adding to its sovereign gold reserves month after month, year after year without pause, they are flashing a massive, undeniable signal to the rest of the world. They have a profound lack of faith in the long-term viability of the fiat currency paradigm. They are actively preparing for the biggest reset, ensuring they have a powerful seat at the table and a rock-solid foundation of physical wealth when the global monetary system is inevitably restructured and revalued. This massive Eastern catalyst provides an unbreakable structural floor beneath the long-term price of gold, driven by massive sovereign entities that completely ignore and do not care about the daily, highly manipulated fluctuations of COMEX futures contracts. They are playing a generational, high-stakes geopolitical game of chess, while Western retail investors are completely distracted by minute-by-minute technical charts and sensationalist financial news headlines. This brings us to a much deeper, more critical analysis of the private wealth management strategies currently being deployed by elite institutions like UBS. In a recent highly confidential private briefing to their top-tier clients, UBS outlined 4 massive structural drivers that are propelling this monumental shift toward hard assets, and it is vital to understand that none of them are temporary or easily reversible. First, they highlighted the inescapable mathematical reality of ballooning global sovereign debt. The debt numbers across major developed nations are so astronomically large that they have lost all practical meaning to the average person on the street. But to a brilliant bond mathematician sitting at a desk at UBS, they signal an absolute mathematical certainty that global fiat currencies must be drastically debased in order to nominally service the astronomical interest on that debt. Second, UBS pointed directly to the rapidly shifting geopolitical landscape, specifically highlighting the fragmentation of global trade networks, the breakdown of supply chains, and the aforementioned weaponization of Western financial systems, which forces adversarial and neutral nations alike to frantically seek neutral, non-counterparty reserve assets that cannot be frozen or seized by a foreign power. Third, they heavily emphasized the incredibly persistent, sticky nature of modern inflation. Despite all the comforting, hawkish central bank rhetoric about eventually getting inflation firmly back under control to their arbitrary 2% targets, the massive structural government deficits, the costly transition to green energy, and the massive global supply chain realignments absolutely guarantee that higher inflation will remain a persistent, deeply entrenched feature of the entire decade, silently and continuously eroding the purchasing power of cash sitting in banks and destroying the real returns of traditional fixed income assets. Finally, UBS noted the immense coiled spring of pent-up institutional demand. Many massive Western pension funds, university endowments, and ultra-wealthy family offices are currently structurally underallocated to precious metals and tangible hard assets, having spent the last decade chasing yield in a zero-interest rate environment. As the undeniable reality of long-term stagflation firmly sets in and traditional stock and bond portfolios suffer, these massive pools of institutional capital will be absolutely forced by their mandates to aggressively reallocate into hard assets, creating an unprecedented tidal wave of sustained buying pressure that will shock the markets. When you carefully synthesize the bullish insights from Goldman Sachs, the four massive structural drivers explicitly outlined by UBS, and the relentless, aggressive physical accumulation actions of Eastern central banks, the macroeconomic picture becomes incredibly, frighteningly clear. Yet the average person remains entirely oblivious, lulled into a dangerous false sense of security by a mainstream financial media complex that focuses obsessively on daily stock market all-time highs while completely ignoring the rapidly crumbling, debt-laden foundation of the currency itself. Let me now give you the three critical analytical questions you must ruthlessly ask yourself if you want to successfully navigate this unprecedented financial dislocation. Structuring these complex macroeconomic arguments into these three digestible, numbered questions will help you instantly cut through the daily noise, avoid emotional panic, and perfectly align your personal financial actions with the undeniable movements of the smart money. Question number one, are global debt levels fundamentally decreasing, or are they compounding at an ever-accelerating exponential rate? The honest answer is mathematically undeniable to anyone paying attention. Government deficits are exploding to record highs even during times of supposed economic expansion. The interest expenses on national debts are rapidly eclipsing funding for essential government services, and there is absolutely zero political will in any major Western democracy for the severe, painful fiscal consolidation that would be mathematically required to actually reverse this catastrophic trend. Therefore, the only possible release valve for this immense building financial pressure is massive sustained currency devaluation. The massive sovereign debt will not be defaulted on explicitly because politicians will never allow a formal default. Instead, it will be defaulted on implicitly, quietly, and continuously through the stealth tax of high inflation. Question number two. When you are suddenly faced with a sharp, terrifying drop in the paper price of your hard assets, are you actually reacting to a fundamental long-term deterioration of the asset's intrinsic value? Or are you simply witnessing a temporary, highly volatile liquidity event driven entirely by distressed, over-leveraged institutional players scrambling for cash? If you truly internalize and understand the jobless homeowner analogy we discussed, you know with absolute certainty that a 12% drop in manipulated paper markets due to sudden margin calls is absolutely not a valid reason to panic and sell. Rather, it is a rare, incredible opportunity to acquire immensely valuable physical assets at a steep discount from deeply distressed sellers. You absolutely must train your mind to separate temporary paper market illusions from permanent physical market realities. Question number three, who exactly is taking the opposite side of your trade when you decide to sell? When retail investors are frightened by engineered volatility, panic, and sell their hard assets at a loss to retreat into the perceived false safety of fiat cash, who is eagerly stepping in to buy what they are selling? The answer is the sovereign central banks of the world, the most elite global wealth managers, and the powerful nations actively preparing for a massive monetary reset. If you are emotionally selling exactly what the most deeply informed, best capitalized, and most powerful entities on the entire planet are aggressively buying with both hands, you are positioning yourself horribly on the completely wrong side of the greatest, most consequential wealth transfer in modern human history. The stark dichotomy between what these elite institutions say publicly to retail investors and what they actually do privately with their own capital has never been more glaringly obvious. They will repeatedly tell the general public that the economy is incredibly resilient, that inflation is merely transitory and under control, and that the traditional fractional reserve banking system is perfectly sound, all while they quietly, methodically build massive institutional lifeboats consisting of physical, tangible assets. This is the ultimate, undeniable us versus them scenario playing out in real time. The entire financial system is specifically designed to keep you trapped in rapidly depreciating fiat currencies, to keep you silently absorbing the devastating tax of inflation, and to keep you reacting emotionally and irrationally to engineered short-term market swings. When the biggest reset finally reaches its undeniable, earth-shattering crescendo, it will absolutely not announce itself with a warning bell. It will simply be recognized in bitter hindsight by the masses as the exact period when the vast purchasing power and accumulated savings of the middle class were entirely hollowed out and systematically transferred to those elite few who possess the foresight to hold tangible, scarce assets. The people who get hurt the absolute most in this unfolding scenario are the ones who blindly trust the comforting public narrative, the ones who stubbornly hold the entirety of their hard-earned wealth in empty paper promises, and the ones who fail to recognize that silent devaluation is a ruthless thief that is already actively inside their home, stealing their future. You have to force yourself to look past the superficial, misleading metrics of stock market indices that are simply priced in rapidly depreciating dollars and instead focus relentlessly on the real yield, the actual tangible purchasing power of your labor, your time, and your life savings. The financial elite are not inherently smarter than you. They simply have privileged access to vastly better macroeconomic data and, crucially, they operate entirely without the blinding emotional panic that constantly plagues and destroys retail investors. They understand perfectly that the current global economic paradigm is an unsustainable mathematical fiction, a fragile system of infinite compounding debt layered precariously upon finite real-world resources, and they are preparing heavily for the inevitable mathematically certain reconciliation of those two opposing forces. The aggressive weaponization of the US dollar has permanently catalyzed a massive global awakening among sovereign nations, dramatically accelerating the inevitable demise of the traditional fiat standard. The undeniable convergence of these massive factors, exploding unpayable sovereign debt, rising geopolitical fragmentation and conflict, persistent, deeply entrenched stagflation, and relentless central bank physical accumulation, creates an unambiguous, flashing red signal for anyone who is actually willing to pay attention and act. You absolutely do not have to be a helpless victim of this silent global wealth confiscation. You have the distinct ability to carefully observe the calculated actions of the smart money, to decode the complex private research notes from financial titans like Goldman Sachs and UBS, and to directly emulate their wealth preservation strategies. The recent 12% drop was nothing more than a brutal test of conviction, a calculated shakeout of weak emotional hands orchestrated by the inherent mechanics and leverage of the COMEX futures market. Those who deeply understood the true underlying nature of the liquidity event held firm with diamond hands or smartly added to their positions at a discount, while those who foolishly succumbed to fear surrendered their generational wealth at a massive loss. The biggest reset is happening right now. It is happening silently, methodically, and ruthlessly all around you. Every single day that passes without you taking decisive, calculated action to protect your purchasing power is another day that your true wealth silently shrinks in the hidden tax of inflation. The entire fiat system desperately relies on your continued complacency. It relies heavily on your inability to translate their complex financial jargon, to see through their deceptively constructive language, and to recognize the true defensive nature of their massive asset reallocations. But now you possess the translation. You have the exact analytical framework required to evaluate the terrifying macroeconomic reality objectively and without emotion. You know for a fact that the concept of genuine fiscal consolidation is a complete political myth, that the astronomical sovereign debt will absolutely be monetized through endless money printing, and that all global fiat currencies will ultimately bear the devastating brunt of the coming financial adjustment. You know that when massive institutions like JP Morgan or Goldman Sachs signal an unambiguous long-term trend to their elite clients, they are not merely guessing about the future. They are actively front-running the inevitable mathematical conclusion of the debt cycle. The choice of how to proceed is entirely yours and yours alone. You can foolishly choose to continue playing the rigged financial game by the exact rules designed to slowly, silently bleed your wealth dry over time. Or you can bravely step outside the fragile paper matrix and intelligently align your wealth with the immutable, unbreakable laws of mathematics, history, and physical scarcity. The coming transition will undoubtedly be incredibly turbulent, marked by further terrifying liquidity events, wild, unpredictable swings in the paper markets, and relentless coordinated attempts by governments and media to completely distract the public from the core, underlying issue of massive currency debasement. But beneath all that engineered turbulence and noise, the slow, steady, relentless accumulation of real, tangible wealth by the world's most powerful informed entities will continue completely unabated. They are intensely preparing for a harsh new world where counterparty risk is the paramount concern, where the empty promises of deeply indebted, desperate governments are viewed with profound suspicion and distrust, and where hard, tangible assets are recognized once again as the only true, reliable measure of lasting economic security. Do not let the intentional complexity and opaque nature of the global financial system deter you from seeing the incredibly simple underlying truth. The math simply does not lie. The astronomical national debt absolutely cannot ever be repaid in current, undebased dollars. The precious purchasing power of your money must and will be violently sacrificed on the altar of inflation just to keep the fragile system functioning for a little while longer. This is the unvarnished, terrifying reality of the biggest reset. It is a fundamental reset of global expectations, a violent reset of historical valuations, and a massive, permanent reset of global economic power from the West to the East, and from paper to physical. The East is actively and aggressively moving away from the dollar. The global central banks are hoarding gold at a record, unprecedented pace, and the financial elite are rapidly positioning their massive portfolios for a brutal new era of sustained high inflation and severe financial repression. You have been explicitly warned. The macroeconomic evidence is completely overwhelming. The institutional actions behind the scenes are entirely unambiguous, and the massive structural drivers forcing this outcome are permanently locked in place. The silent devaluation of your wealth will only rapidly accelerate as the sheer panic and desperation of central planners inevitably grows. They will desperately try to obscure the terrifying truth with new confusing financial jargon, new temporary stimulus fixes, and new geopolitical distractions, but the fundamental mathematical trajectory of the debt spiral remains completely unchanged. Your ultimate financial survival and the future prosperity of your family completely depend on your ability to see clearly through the grand illusion, to completely ignore the daily mainstream noise, and to act with the exact same cold, calculating, emotionless rationality as the massive elite institutions that truly run the world. This is absolutely not a time for blind panic or emotional paralysis. It is a time for immense clarity, unshakable conviction, and swift, decisive action. The incredibly brief window of opportunity to position yourself ahead of the unaware, panicking masses is closing rapidly as the relentless pace of global currency devaluation accelerates and the massive institutional accumulation of hard assets intensifies by the day. Every single moment of hesitation, doubt, or inaction is a silent, tragic surrender of your family's financial future to a ravenous system that views your hard-earned wealth as nothing more than acceptable collateral damage in its desperate, futile fight for survival. You must immediately take control of your financial destiny. You must relentlessly educate yourself on the realities of the macroeconomic landscape. And you must act decisively before the silent, creeping reset becomes a deafening, inescapable reality for everyone who foolishly failed to prepare. Understanding the mechanism is the first step to not being on the wrong side of